this might be the most hated bull market I've ever been a part of.
The most
People
hated, you
just,
said?
yeah, the most hated bull market I've ever been a part of. Everyone's looking for a reason for it to turn around or crash. You know what? Stock markets do crash, do have pullbacks. It's very normal. Every year the market's going to pull back 10%. Almost every year it pulls back at least 10%.
Wealthies, welcome back. If you're new here, this is All the Wealth, Wealthmore's wealth building channel. And I'm Mical Jeanlys-White, the founder and CEO. And with me is our very own Matt Levy. Matt is our renowned CFA who helps us with all the topics about money and the markets. And today we are here to talk about the state of the economy. We are deep into Q4, but we're also celebrating our 1 year anniversary of All the Wealth. This is our first episode going into year 2. So many exciting things to come. We're going to do in-person events, more topics about money, bring on some other guests and partners. And we also launched our merch shop. So you guys can live the mission, wear the mission. We'll drop the link in the comments here, but you can go to our merch shop and pick up any of our hoodies, t-shirts, sweatshirts. The signature one says none other than wealth is for us all. So live it out loud, wear it, share it. Perfect time for the holidays for you guys to pick up some merch. So now, Matt, let's jump into it. What is going on?
2025 has no shortage of twists and turns. But if it had a headline, we kind of saw on the economic side anyways, that we're going from hot to warm growth is how I would characterize it. Inflation's been sticky to Fed's point, but drifting lower, and markets are kind of trading more on expectations than the latest data point. It's almost like data doesn't matter at this point. We're kind of in that whole AI-based excitable economy, if that makes sense.
Yeah. You know what's so interesting? When we last talked about the state of the economy, right? This was on the heels of the Fed meeting, 25 bips rate cut. You know, I felt like we were getting a little bit of breathing room, that maybe we would sort of ride out the end of the year with a few more rate cuts. Job market would, stabilize a bit more. But in the last, 4 to 6 weeks, what have we seen? Tariff talks have come up again. Still
They
tariff,
won't go away either.
they won't go away, right? So now we are talking about back and forth tariffs with China, one of our biggest trade partners, and Canada as well. We have a government shutdown. Government is still shut down, and we don't see the sort of active negotiations that we've seen in the past. At least they're not outwardly public. And then we've gotten a slew of job cut reports. Target is cutting jobs, Amazon is cutting jobs, Meta is cutting jobs. And so all of these things that, frankly, 4 to 6 weeks ago, we felt like, okay, we might have some clarity, feels very unclear again.
Yeah, and that's the tricky part, and the Federal Reserve's got quite the needle to thread because their two main things they need to do is control inflation, which if inflation is too hot, they need to raise interest rates and get full employment in the economy. So what we're seeing is as those job numbers kind of tick to the worst side, that puts them in a bind of, hell, we need to drop interest rates to kind of spur the economy. But if inflation stays sticky the way it is, especially core inflation, so on the things you and I spend on every day, it's hard for them to cut into that because it could stoke more inflation. And we saw, most recently how bad that can affect everyday people. So it's a tricky spot. It's not all bad. Obviously, there's lots of good things going on as well in the economy. Some of it's concerning, like the AI trade seems a little bit overextended at this point. Everyone's kind of investing in each other's companies, it feels like. But at the end of the day, I wouldn't say 2025 is good or bad. I'd say it's almost like a reset year. Markets are kind of deciding how much of that reset in growth to maybe different levels already priced in as well.
I mean, for wealthies out there, we can only control what is within our control, right? So this inflation thing has been hanging around. It's like a just this set of clouds that we can't seem to clear. And I know everyone's feeling it. Like literally, I'm in the grocery store and the woman ahead of me is like, and the cashier is talking about just how expensive basic groceries are. And people are just thinking about how long they've been living with this, right? So from a budget perspective, that means you've got less disposable income because your necessities are more expensive. So, wealthies, you guys have to think about where can I cut? Like, where can I find ways to save money so that I can fund my long term goals, right? And some of you out there might be feeling like there's nowhere to cut.
Yeah.
Like,
Yeah.
I
I hear
have
that
done
a lot
the
too.
cutting and there's nowhere else to cut. But those are some of the realities in terms of, building wealth is a long-term journey. And there might be points in the journey like this where it feels like I can't find 5 to 15% of my income to put away for savings and investing. And frankly, if you can't, that's okay. That is part of the journey. This is not a sprint, it's a long-term journey. So I would say point 1, do the math, look at the budget, see if you can find places to still manage to cut the budget so you can hit your savings and investing goals. But Matt, even if we get 2 rate cuts before the end of the year, we're still likely running hot on inflation.
Yeah, and that's something everyone, not even just in the US, but globally has had to deal with. And one thing I like to tell people and family and friends as well is nothing really beats automation on that side. If you don't pay yourself first, it's not likely you're going to end up paying yourself because all these little things start to add up over the month, and you go out for that meal, or you just, if you have money in your account, you're more likely to spend it, right? So that's one thing that I like to concentrate on with people is just pay yourself first. And what I mean by that is automate your savings to make sure you're hitting the savings rate you want to hit. And then you can have the rest of your money to spend on now.
Yeah, I'm so glad we're talking about this. We don't normally talk about like budget and savings, but it feels so appropriate as we're sort of getting into the end of the year and people are thinking about, resetting for 2026. It's a great time to sort of revisit how you've approached it in the past. And I love your point about pay yourself first, which I do not care for the budgeting method where you do everything and then you say what's left to save and
Yeah.
invest. I think that because we all can like inflate our lifestyles, I want you guys doing it exactly the way Matt said. Like, pick your number to save, invest, and then work your way through what you have to spend. You can
Yeah. And
all,
if you're, I was
yeah,
gonna say, if you're we're not all that way, but if you're a math brain like myself, you can even look at little projections on how little amounts will kind of grow over the long term. And it's kind of fun to look at, oh, hey, if I save $200 a month for 10 years at 8%, what's that dollar going to be? And it's because of the effect of compounding, it's much more than you think it is. So even little bits can definitely help.
yeah. And we should drop a calculator in the
Yeah.
when we post the
I can't
episode.
do it in my head. Not yet. Not yet.
You guys will be amazed, right? Put in like $50 to Matt's point, $100. It really does add up. And just put in like a few from modest to high in terms of compounding interest. So anywhere from 5 to 12%, and you'll see the impact that that has over time.
Yeah.
Yeah. So I want to get into the stock market here, right? Because the market also doesn't like inflation because that means you guys don't have as much money to spend. And if you're not spending, companies can't make money. If they can't make money, they can't earn profits, and the economy doesn't grow as quickly. So the markets are watching this inflation. They're watching the job cuts because if companies are cutting, sometimes it's a good thing if the company had gotten bloated, if you will, but less people generally equals less productivity as well.
And the base numbers we're seeing in like unemployment, for example, they haven't been that terrible, at least from what we've been given, despite the shutdown reports. Where unemployment's around 4.3% and change, up a little bit from prior years where it was hanging around 4%. So when there is some more unemployment, and like I said, inflation's been kind of sticky at 3. If we're looking just at stock markets, you wouldn't think that anything bad is happening because stock markets are blowing through all-time highs almost every day. It's a good time to kind of remember that the stock market is not the economy. The stock market kind of is based on what's going to happen in the future and what's happening around the globe. So, we're seeing an easier monetary policy from the Federal Reserve. So more money in the system, lower interest rates tend to be good for stocks. And yeah, it's been quite a good year, and we kind of hope that continues, but we need to kind of put expectations in place as well. That it's looking pretty good, but not everything is good out there too.
Yeah. I'm so glad you're highlighting that the stock market is not the economy, right? It is a outcome of it to a certain degree, but it is not the economy. I certainly am very happy with how the market is performing. It's been a very, very good year for investors. But Matt, there are a few sectors driving that, right? And people are also looking at those sectors. And as investors, you guys should understand like what is driving the stock market right now. So we should double click into the sectors that are driving so much of this growth.
Yeah, it's I would say, another tech-driven rally we've seen. If you look at the headline stocks, the Nvidias, the Nvidias of the world, and all that whole sector has really kind of been overbought, in my opinion. It's a big story for sure. It's a big change, but we're seeing valuations that are getting a little bit extended, if you could say, from a nice way to say it. But at the end of the day, if those narratives continue, that can certainly continue on for longer. But yeah, I think that's the main driver of the market right now, in my opinion.
Matt, can you explain to listeners like what it means to be overbought?
Yeah, so when people get really excited and everyone's kind of in the company, what you get is a price that moves way faster than any current earnings or any types of valuations you can do. So when I say overbought, I mean that the stock has gone so far ahead of itself that you would consider from a from a technical standpoint that there's been too much money put into the buy side. It needs time to kind of settle down, get into a better place from a stock price perspective, if that makes sense.
Yeah. Do you want to explain? I know we're getting technical here, but I this is one I think folks should be aware of when people say overbought and what that means from like a price per earnings, because you're
Sure.
essentially buying some big assumptions about future earnings.
Yeah. So for example, say something's priced at like $20 per 20 PE, price to earnings. What that means is you're paying $20 for every dollar of earnings, just to make it make sense. Some of these companies, they'll trade 40, 50, 60 times earnings. And that's when you kind of have to take a look and say, if it makes sense from a growth perspective, if those earnings, if that bottom part of the denominator can catch up and make it more reasonable, then yeah, that it justifies that price, if that makes sense. But when we say overbought, you're looking at PEs that can get way beyond what you think they should be. And then you're kind of thinking, okay, that's got some sort of thing happening with it that maybe people are getting too excited, or everyone's buying in. So that price to earnings needs to come down somehow, either from the price of the stock or the earnings going up. Usually, we see at some point that price will come down. So when I say overbought, it doesn't necessarily mean the stock will go down tomorrow or the next day or next week, but at some point you would think some normalization would happen with the stock.
Yeah. And this is a good one to explain, particularly for tech stocks and growth stocks. These tend to be a bit more speculative, if you will, right? So these are companies that are growing quickly. Their markets may not be as stable, so they tend to have these higher PEs, and many deliver. So we're not saying that, growth stocks should not have higher PEs, but it is kind of like one of those areas that, you should be watching as an investor in growth stocks. But it also speaks to the importance of diversification, right? And a lot of the talk right now about this sector highlights the importance of diversification.
Yeah, and if you're in a basket of stocks that are all, overextended or overbought, once that turns, that's why you need diversification. You also need to be in sectors that are maybe not as liked right now, maybe undervalued, maybe underappreciated, so that when things turn to from one sector to the next, then you get a combination of that. And that's the whole idea behind diversification is you shouldn't have all your eggs in one overbought sector, even if it's doing really well this year. Maybe next year it doesn't. So you want to be your money spread across these types of things.
Yeah. And Matt, do you consider the AI trade kind of a sector trade as well? Because that's probably what's fueling that's a big contributor to folks worrying about, hey, is the market overall overbought? Is there a correction or worse coming? We know there's Andrew Sorkin's book out there as well. Um, sort of comparing today's market to the market in 1929 and sort of like the big market crash, but curious to hear your take on it.
Yeah. So, I mean, are we in a bubble, right? That's what a lot of people have been asking. You know, it, this might be the most hated bull market I've ever been a part of.
The most
People
hated, you
just,
said?
yeah, the most hated bull market I've ever been a part of. Everyone's looking for a reason for it to turn around or crash. And you know what? Stock markets do crash. They do have pullbacks. It's very normal. Every year the market's going to pull back 10%. Almost every year it pulls back at least 10%. So um, what we're seeing is some of it's a little bit of muscle memory from 2020 and 2022, thinking that something bad's going to happen. Some of it's concentration anxiety. Some of it's fair. AI and tech are priced for like pretty rosy adoption curves, right? You think that they're all going to have this miracle cost saving, efficiency increasing crystal ball that's added to their company. It doesn't always work like that. Maybe a few do, maybe a few don't. But we're definitely seeing these PEs valuations elevated above longer term averages. And when you see that, you tend to get a reversion to the mean. But, for me, if I'm looking at investing, I don't really invest for the next month or the next year, even, right? I invest for, is the market going to be higher 5 years from now or 10 years from now or 20 years from now? And for me, that answer is pretty clear. So, yeah, it's elevated and there will be a crash at some point for sure. There will be a pullback at some point for sure. But I think just as long as you stick invested and properly invest like to your risk tolerance, then you're going to be fine over the longer term.
Yeah, yeah. And I know we use these terms, pullbacks, corrections, crashes, but I think it would be helpful for folks to understand, like, percentage-wise, like, we know what they are, but I wanna make sure
Yeah.
you guys are not overreacting when you hear any of these, so I'll let Matt sort of dimension each of these for you.
When I say you have to take the emotion out of it with money, but when I say pullback, I mean like 5% pullback within the index, the S&P 500. 5% corrections happen all the time every year. When I say 10%, that's a larger
Like a
um,
correction, right?
correction. Thank you. And then when I say crash, I mean something over 20%. So like we saw in in COVID, the 2020 crash. When I say crash, it was over 20%. So that's what I mean by that. Crashes happen every 4 to 7 years. Pullbacks happen almost every year. If they don't happen this year, they happen next year type thing. And 5% drawdowns happen almost every year.
Yeah. Yeah. I wanted to make sure we dimension this for folks because, when I talk to folks, their interpretation of crash is more like 90%.
Okay.
So
Yeah.
or hear crash, they hear my portfolio, if it's 100,000, is going to go down by 80 or 90%. And that sort of emotion or frankly false belief because that's what you thought crash meant is what drives a lot of the panic selling, right? Like a lot of people think crash is that. I think if we were to take this on the road and stop people on the street and say, hey, what does it mean if the stock market crashes? What percentage do you think it goes down? I don't think most people are saying like 20 ish. I think people are thinking 50, 60, 70, 80. So we wanted to correct that here a pullback, 5 to 10%, correction, 10 to 20, crash, 20 plus. So when you hear
Yeah.
pundits saying the market is pulling back, and frankly, I see these folks very emotional and animated when they talk about any of this. I can see how a consumer might think the pullback is like 50 and the correction is like 70 and the crash is 90. And that's really, really not the case.
Well, it's the headlines and the everything coming at you, like even on a day where the market pulls back 1%. And next time, like I encourage the viewers, next time you see the market down 1%, go take a look at the headlines. They're gonna say the market's crashing, the sky's falling, all that kind of stuff. But reality is 1% pullback after, a 20% run isn't really a big deal, right? That's kind of part of
You got it.
investing.
You got it. Yeah.
And Warren Buffett, the legendary investor, his whole thing was if you can't stomach a 50% loss, you shouldn't be in stocks. But he's not saying that happens every year or every other year. That might happen once in a lifetime type thing. So yeah, it might feel that bad, when if you lose 50 or 30 or 40%, it's going to feel like 80 or 90%. There's lots of psychological reports on how losses feel worse than wins do, but the reality is it's not that extreme.
Yeah. Yeah. And I definitely wanted us have you guys look at these headlines when you hear these words being thrown around. I want you to like pause, look at the actual numbers and put it in the right bucket. But I also want you guys looking at your actual account and say to yourself, what am I okay with? And making sure your investments are diversified appropriately. We have our Wealth More portfolios here. When you guys are investing, you answer questions to tell us your risk tolerance. Want to make sure you're not more bravado than you actually can take because that plays into it. But we want you guys to be informed investors. We don't want you to be triggered by clickbait and sensational headlines. We want you guys to be able to step back and be like, okay, this is just to sell papers or get
Yeah.
eyeballs. Here's what's really happening because I watch it and I'm just like, "OMG, stop it."
You have to sometimes laugh at it when you see people like, it's come on, guys. Like, we know what you're doing. I guess fear
You
sells,
know,
right?
we
That's the
know
problem. Yeah. Yeah. That's
that and
just
I
it.
know, but I'm always like, "OMG, I hope people are not in their accounts selling off because these pundits wanna keep you glued to the screen." So hopefully you guys are getting these nuggets and now you understand these numbers so that as you go into the end of this year and there's always a bit of correction and pullback, or the more you are rational investors versus emotionally triggered by headlines, worrying for things that we know are pretty like cyclical in the market. But it's also why we encourage you guys to have your one on ones, meet with your wealth advisors, ask them these questions. You can schedule it in the app. You can also message them any of these questions, frankly, to just be like, hey, saw this headline. What's your take on it?
Yeah. And, it's always good to look at your portfolio from time to time, either do a like a dated rebalancing or allocation rebalancing. So, when you invest in a balanced portfolio, if you were 50% stocks and 50% bonds, but stocks have rallied 20% and bonds are up 4, you might have unintentionally increased your risk profile. So that's why you set up some sort of rebalancing strategy to make sure that you're never getting too aggressive for what you think. And, year to year, that might not make a big of a difference, but after 5 years or 6 years, your portfolio can drift pretty far away from what your intention was. So,
So, Matt, as we close out this year, there are a few things we want people to walk away with. One, great time to look at your budgets, make sure you have that savings and investing goal top of mind. What do you want them to subjectively look at the market and take away from?
yeah, I think there's a lot to be optimistic and careful about in going into 2026, or at least the end of 2025 into 2026. Inflation is lower than what we saw back a couple of years ago, even if it is a little bit sticky around the core inflation. Yeah, and the Fed is shifting from putting the brakes on to being neutral or supportive. So that's quite good for not only the economy, boosting the economy, but for stock markets in general, for sure. Corporate America is doing its thing. They're investing a lot in AI and automation. There's an energy transition. A lot of capital expenditures from companies will compound productivity. Companies are going to get more efficient. More efficiency means better earnings, and earnings are by far and away the best predictor of stock markets. Some things to look out for, the household and corporate balance sheets. They're not pristine by any means, but we're not in a 2008 scenario or 2000 scenario where companies and families are overextended than what they should be. So for me, I'm pretty optimistic heading into 2026, but always, again, as long as you're investing with your risk tolerance, you shouldn't really ever have an issue. You got to keep your eyes on the prize in the long term.
Yeah. Yeah, I definitely echo the risk tolerance, the long-term approach, but also just checking in on your investments, making sure, hey, the strategy still makes sense for me. Um, that's why your wealth advisors are here. I'm not a believer in set it and forget it. I think you guys should be aware of what's happening in the economy, aware of what's happening in the markets, and have a good sense of how is my money performing? How are my investment strategies? I don't know who came up with set it and forget it, but no, we want you guys to be informed investors.
And how many people actually forget about it realistically?
I mean,
Yeah.
my money is routinely on my mind.
Yeah, exactly. A couple other things to leave everyone with is, like, again, we talked about earlier, the economy is not the stock market, so don't necessarily put those two together. Related for sure, but not the same thing. Time in the market's probably more important than actually timing the market. And I bet a lot of people are looking at the markets at all-time highs right now and thinking, I'll just wait for a pullback. That's not actually a great effective investing strategy. All time highs historically often lead to new all time highs. So, yeah, I just say I wouldn't use that as a reason not to invest. It's better to start, get more time than it is to say the market's hitting all time highs and there's no point. There's definitely still room to go.
Yeah. Yeah. I think to your point, Matt, people should just have that auto setting and just that's just what
Yeah.
you have a certain amount of money that you are constantly investing, and you get the benefit of the average dollar costing impact over time, but trying to time the market is a fool's errand, like, hedge fund, Wall Street traders have tried it and failed time and time again, so we would highly discourage you from trying to do
Yeah.
that.
Yeah. And those investors also put billions of dollars into trying to figure out how to time the market, and often a lot of them fail. So, if you're trying to do it with your savings and thinking that you're smarter than the bulk of these investment professionals, I might make you question your assumptions.
Yeah. So, wealthies, this is what we wanted to leave you guys with a bit of here's what we're seeing in the markets, making sense of it for you, but really just wanted you guys to be informed and empowered, ending the year strong, checking in on your portfolios, meeting with your wealth advisors, and frankly, planning to have a very good 2026.
Agreed.
Awesome. Awesome. Well, thank you, Matt.
Thank you.
Wealthies, this is all the wealth. Stay tuned. More to come in year two, but stay on track, stay focused, meet with your wealth advisors. And until next time, this is all the wealth. Thank you, guys.